Good evening. In the previous video of the same subject which I have made and uploaded, it has been brought to my notice by some of the friends that the audio quality is rather poor. Hence, I am presenting the same video with the same subject again, hoping that this time the audio quality will be good. Having said that, coming to the subject, as I mentioned earlier, every script has a trading data for a particular period. Herein you will see on the screen the data pertaining to the Nifty from 16/3/2020 to 16/4/2020. The data column comprises of date on which it was traded, open price of the index, high price of the index, low price of the index, close price of the index, and volume. These are the columns which you can see here for the Nifty for a particular period. And there is one additional column called as open interest, which is not applicable to this particular script or index because it is cash Nifty. Open interest is not reflected here. Open interest is more concerned with futures and options. So let us leave that apart. And in the same way, if you see the data related to any other script, it will also appear like that. For example, we shall see another script. Is data related to Infosys. It also has the same fields. So date on which it was traded, open price, high price, low price, close price, and volume. So seeing it with the naked eye, it will be difficult for us to judge whether the script has potentiality to move up or move down. As mentioned by me in the previous videos, for making profit or the ultimate objective of investments in shares or in any other avenues is to make profit, and profit is made by buying at low and selling at high. For that, we need to ascertain and script has potentiality to move up or move down because profit can be made in both ways, one buying at low and selling at high, or selling at high and buying at low again. For that, we need to ascertain and make a judgment. By looking at the data with the naked eye, it is difficult to ascertain whether the script has potentiality to make a move either towards upside or towards downside. For that, what we need? We need to convert form called as graph, which I mentioned earlier. I will show the data being converted into a pictorial form now. Analysis. With the employment of the charts, we also use other techniques for making a judgment. Having said that, now I would like to deal with some kinds of important kinds of charts which we use one by one. And please note that this is only an introductory video for charts. At a later stage, we will discuss each and every chart in detail at a later stage. But for the time being, kindly do remember this is only an introductory video. Right. Thank you. The first and foremost chart is line chart, as you would see. This is what is called as a line chart. What is the line chart? As I mentioned, the data will have four types of fields: open price, high price, low price, and close price, along with volume. For the charting of line charts or pictorial form of the line chart, only close field is taken. The rest of the three fields, open, high, low, are ignored. Only close is plotted. Close for the day is plotted. As is evident, you can see that on x-axis, trading days are plotted, y is price. So when close for a day is plotted, it would appear like this, which is called as line chart. As you would see, even though it is a line chart that is representing close of the script, the line never moves in a linear fashion or in a straight line fashion. For some days it goes up, as you would see from here to here. It goes down from here to here. Again it goes up, again it goes down, so on and so forth. So it never behaves in a linear fashion. We need to analyze the likely movement or behavior of the script. And this close being very important, since close is the last trading price of the trading session. It shows the investor confidence in the likely movement of the script for the days to come. If the close is successively going down and down, it shows that investors are not having confidence in the particular script, and it may reverse soon. So of all charts, it is very, very important chart as far as charting is concerned. And we will examine the next kind of chart. The next kind of chart is bar chart or open, high, low, close of the chart. As I told you, the data comprises of the four price fields: open, high, low, close. All these prices are taken into consideration for plotting them on the graph, which is called as bar chart. Bar is nothing but a small line representing both the four types of price fields. As you would see here, I will simply enlarge this so that the data can be analyzed easily. Here we will examine the anatomy of the bar. Here you can see it has a top, it has a low or bottom, one left tick and one right tick. The low or the bottom of the bar is low price made by the script during the day. The high or the top of the bar is the high price made by the script during the day. The right tick is the close for the day, and the left tick is the open for the day. Thus, it can be very easily seen how the price traveled during the day of trading. And as I mentioned, at the bottom of each and every chart or the window, volume for the day is plotted. Here it is volume. And the anatomy of the bar tells us so many things: where the script opened, to what extent it went up or went down, where it closed. You will see for yourself when here you can see that the open is here and close is here. So open itself is very near to the high, and the price came down during the day, and the close is near to the low. It means the price has been hammered down during the day, which indicates that the price of the script is likely to go down in days to come, which is evident here. Again, open is high, and again here. Now you will see here, here the price opened at this place, went down up to this extent, and it went up and closed here. We can say the price first went down and later went up because the close is near to the high. It shows the investor confidence along with the other particulars. As you would see here, the for the day it went down, but later it went up. In the middle of the bar, the price closed along with increase in volume. This shows the likelihood of the price going up again. That you can see from here. Like this, the anatomy of the bar along with the volume movement, which we will take up and consider in coming videos. For the time being, please do be informed that the bar chart is one of the major charts used by the analysts for making investment decisions, in which open, high, low, close, and volume of the stock traded is considered. We will consider the next kind of chart. Okay. Now, when the closing price is less than open, you will have a black candle. And the area above open or area below the open and close are called as shadows. As you will see here, the price opened here, went down up to this extent, and later went up to this extent and closed here. That means here the candle is a long one, white one. So this is the shadow area. And you will see from somewhere that there is no shadow area upside. Here you will see very easily the open is close is less than open. That means the candle opened here, which itself is the high. Later it went down and closed here. So by looking at the chart, you can see whether the stock opened and closed at lower or higher levels, and certain formations appear on candlestick charts, which are very important for presuming the future course of action, like dojis, hammers, spinning tops, so on and so forth. We will take up each at the relevant level of the study. Okay, next, we will take up the next chart. Here, it is called as Kagi chart. The making of the chart is slightly different from the traditional charts, wherein a certain percentage of change is considered. Otherwise, the change below that percentage is not taken into consideration and no price is plotted. When the price, trend changes from bear to bull, the line becomes thick as you see, and bull to bear, the line becomes thin. It is evident from the chart you can see. So it is another form of analyzing the trend instead of the taking into consideration other traditional aspects. It is a development over traditional charts. In the similar manner, there are some other advanced charting techniques which we will consider. We will see the next chart. This is called as point and figure chart. The construction of the same is also somewhat different, which I will explain in the coming videos. And first be informed that this methodology of the point and figure chart is slightly different from the traditional charts, which depicts the ongoing trend. When the trend is down, block boxes will appear. When the trend is up, white boxes will appear, in which we will have both the figures. This is called as point and figure chart. This is one kind of, as you will see, when compared to other traditional charts, the trend can be easily identified from figure. We will consider next important advanced chart as a Renko chart. As I explained, this is also a special type of chart. The construction will take into uh, take up this matter at a later video when it comes to discussion of Renko charts. But for the sure, white squares appear, white diamond shapes appear when the trend turns into various block diamond shapes appear, as you would see. The for the last 10, 15 days, market is going down and down, as you would see here. And I put the present this Renko chart on 28th of February, very advanced. Turnaround here on 7th of April. So this way the trend reversal can. This is three-line break chart. As you would see, trend when trend changes, block ribbon type formats appear, and when trend is bullish, white ribbon like formats appear. So when there is a change in the trend, it can be easily identified, and the construction of the same is also different, which we will take up in another video when it comes. And we will discuss two kinds of important charts which are somewhat special in their making. I will explain one and one. Here it is called as candle volume chart. As the name is self-explanatory, the candlesticks are mixed with the volume traded on the particular day. When the price action with the volume and injected into it, it gives a volume coupled with the price itself. which I will show. This is called as equivolume chart. This can be, by looking at it, can be ascertained whether prices are moving on large volumes or light volumes, and on a certain analytical study of this chart, one would come to know how much volume is required to reverse the trend. Is it easy to get the reverse the trend, or does high volumes are required to reverse the trend? And when certain formations occurs on the chart of the equivolume, trend reversal can be anticipated. That we will discuss. As I explained, this is only an introductory video for various types of charts. We will take up the charting in detail from the next videos. Till then, thank you very much and goodbye.